Two people can retire with the exact same amount of money, same age, same investments, even the same spending needs, and one of them can end up running out of money years earlier. It's not because they invested poorly, but because they took income the wrong way. Most people think retirement planning is about building a big portfolio. What they don't realize is that retirement is really about designing cash flow, where the income comes from, whether it's Social Security, your pension, investment distributions, whether you take some now or later, how much, and how it's all taxed, because some of this is taxed as ordinary income, and some is taxed more favorably, how it affects your Medicare, because how much you make during retirement can affect your Medicare premiums, and how this affects your plan as a whole, because all these things are interconnected. That's what actually determines whether a retirement plan holds together long term. Here's how we actually structure retirement cash flow. Step 1, we need to determine an actual spending target and start to categorize our expenses. Step 2, identify guaranteed income sources. Step 3, we start to build a tax efficient plan to make up the income gap. Step 4 is design an investment portfolio. This is to create a cash reserve or a war chest to smooth out the sequence of return risk or other risks while keeping non-income assets growing optimally. And step 5 is coordinating taxes annually to determine opportunities for tax strategies. By the end of this, you'll have a track to run on if you're planning your own retirement. Here's the mistake most people make with retirement. They think retirement planning is just about building one giant investment account. We don't look at it that way. We look at retirement like building a cash flow system. Because once the paycheck stops, the portfolio now has a job. Its job is to create income consistently and efficiently for potentially 30 years or longer. So the very first thing we do is figure out, what does retirement actually cost? No guesses, real numbers only. We have housing, core expenses, travel, lifestyle spending, healthcare, gifting, taxes. Let's say a couple needs about $12,000 a month after taxes to comfortably retire at 60. What's interesting is once you actually organize expenses this way, people start realizing not everything is truly a fixed monthly expense. Some expenses are mandatory, like housing, insurance, and basic living costs, and some are flexible, like travel, entertainment, gifting, and any luxury spending. Some expenses may only happen a few times per year, maybe a big vacation, property taxes, a home project, or helping your kids. So instead of retirement feeling like this overwhelming giant number, it starts becoming more organized and manageable. People begin realizing, okay, maybe we don't need the exact same amount every single month forever. And honestly, that changes how people feel about retirement completely. Next, we want to identify guaranteed income sources. This is the income that may already be coming in regardless of what markets are doing. Things like Social Security, pensions, rental income, annuity income, anything that creates a recurring cash flow. And this becomes really important because these income sources help reduce pressure on the portfolio later. For example, if someone needs $12,000 per month gross in retirement, but Social later covers $4,000 of it, the portfolio may only need to solve for the remaining $8,000. That changes the entire withdrawal strategy. But timing matters too, because someone retiring at 60 may not start Social Security immediately. They may wait until full retirement age or even age 70. So now we start mapping out when each income source begins, how reliable it is, and how much of the retirement lifestyle it actually covers over time. And this is where people start realizing retirement income is much more layered than expected. It's not one giant account producing one giant paycheck. It's multiple income streams working together at different points throughout retirement. The next step is building the plan for the income gap, meaning what amount still needs to come from the portfolio. This is where tax planning starts becoming incredibly important because not all investments are taxed the same. Some investments create ordinary income. Examples of this would be interest from most bonds, CDs, and money markets. Some create capital gains when they're sold, and some create little to no taxes at all, like muni bonds or an active tax loss harvested portfolio. So instead of randomly withdrawing money, we start coordinating where income comes from each year. Maybe some income comes from brokerage accounts. Maybe some comes from retirement accounts. Maybe there are Roth conversion opportunities in lower income years. Maybe we intentionally stay within certain tax brackets. The goal is not just generating income. The goal is generating income efficiently, because two retirees with the exact same portfolio can have completely different outcomes, simply based on how they manage taxes and withdrawals over time. This becomes even more important once you factor in Medicare premiums, required minimum distributions, otherwise known as RMDs, Social Security taxation, and future tax rates later on in retirement. If you want to know how to identify the tax inefficiencies in your current investment portfolio, there'll be a link in the description for a tax webinar we did. Please watch it. You'll get a ton of value. It's absolutely free. Next comes designing the investment portfolio. Now, in our experience, this is a common mistake for retirees and advisors alike. Designing an investment portfolio before understanding cash flow, income gaps, and tax strategy can result in everything costing way more, including taxes and even healthcare costs later on. For purposes of this video, let's assume we did everything in the right order. So now the question becomes, how do we design the investment strategy? Some people choose a conservative or moderate allocation and simply take 4% from the portfolio each year. And that can work, but we think retirement income can be structured much more intentionally than that. This is where the war chest strategy comes in. This is where we start separating assets based on purpose, because one of the biggest risks in retirement is sequence of return risk, which is simply taking withdrawals during major market declines early on in retirement. That can permanently damage a portfolio, especially if someone retires right before a recession or a bear market. So instead of having the entire portfolio exposed to market volatility while also needing to generate monthly income, we may keep several years of planned withdrawals in safer investment. This includes cash, treasuries, short-term bonds, or a conservative fixed income. This becomes your income cash reserve, or what we like to call it, the war chest. The purpose is simple. If markets decline, the client is not immediately forced to sell long-term investments at depressed prices just to create income. The war chest buys time, it creates flexibility, and it allows the long-term growth portion of the portfolio more time to recover and continue compounding over time. Meanwhile, the assets not needed for near-term income can stay invested more efficiently for long-term growth and inflation protection. This is where retirement planning starts becoming much more intentional than simply withdraw money every month and hope the market cooperates. Because you and I both know that's not up to us. Now, the final step is ongoing tax coordination. And this is where retirement planning becomes an ongoing process, not just a one-time plan, because retirement should not run on autopilot. Every single year, tax laws change, markets change, income changes, spending changes, and that creates new planning opportunities constantly. Some years may create opportunities for Roth conversions, and some years may be better for realizing capital gains. Some years may require pulling more heavily from certain account types than others, and all of this starts impacting things like future RMDs, Medicare premiums, Social Security taxation, and overall lifetime tax exposure. If you've done a great job saving prior to retirement, and you have a mix of after-tax assets, Roth assets, and pre-tax retirement accounts, now you have every chess piece on the board. That creates flexibility. It means you can proactively decide where income comes from each year instead of being forced into one option. You may be able to adjust income strategically to qualify for things like the enhanced senior deduction. You may be able to better manage healthcare and Medicare related costs, and in certain years, you may create more room for Roth conversions while staying within target tax ranges. But none of that happens accidentally. It only works if everything is coordinated properly. That's why we believe retirement planning is much bigger than just picking investments. It's really about how all the moving pieces work together over time. So instead of just asking, how'd the portfolio perform this year? We're also asking, was the income generated efficiently? Did we stay within the target tax ranges? Are there opportunities to improve the long-term plan? Because at the end of the day, it's not just about your investment returns. It's about how much of those returns you actually get to keep and use for your spending. So when you put all this together, you start realizing retirement planning is really a coordination problem. Cash flow, taxes, investments, healthcare, withdrawal strategy, risk management, they all affect each other. And this is why we believe the order of operations matters so much. Most people start with investments first. We think investments should support the plan, not drive the plan, because the reality is you can have a great portfolio and still have an inefficient retirement. You can take too much risk, pay unnecessary taxes, trigger larger Medicare costs, withdraw from the wrong accounts at the wrong times, or create income problems during bad markets. The goal is not just to retire. The goal is to create a retirement system that is durable, flexible, and efficient over decades. And when done correctly, it can potentially allow people to spend more confidently, reduce financial stress, and enjoy retirement more than they originally thought was possible. And this is really what we built our Retire at 60 free training around, helping people understand not just, do I have enough, but how do I actually structure retirement the right way? Because retirement is much more than hitting a number. It's understanding how all the moving pieces work together once the paycheck stops. So if you're someone thinking about retiring around 60, or you simply want to better understand how to turn your assets into a long-term retirement income system, we'll put the link to the free training below. It goes much deeper into the strategies, frameworks, and planning concepts we use when helping our clients build retirement plans. Hope you found this video helpful. Thank you for watching, and we'll see you on the next one.